Okay, so the one from the Rational Miner community. I know it's never going to happen given the personalities involved, but here we are. But would love to hear Ben and Dan debate factor tilts versus pure market cap weighted approaches. We've heard the argument many times in the community and elsewhere, but would be interested to hear more of their personal opinions come out in such a format, for example, in a future AMA. And here we are. And the second related question that was from the AMA questions form. Could you explain in simple terms the difference between and why you would recommend a DFA fund or something like VEQT or VGROW? Thanks for all the great work you do on RR. So I've got some short comments that I'll share first, and then I think, Dan, you've got more interesting stuff to say on this.
I'm not sure what the personalities are that he was referring to. It must be your fiery temper, Ben, that I was cowering, but
Yeah,
let's give it a shot.
I don't really understand the personalities comment either. I think that like if there was an ideal combination of people to discuss this topic calmly and rationally, it's probably us.
I hope so. So let's give it a try.
Yeah, we'll do it. So I think market cap weighting with a globally diversified portfolio, and I do think that's important. Yeah, like not just a U.S. market cap weight portfolio, for example. I think that's a perfectly fine strategy, and it aligns with theory and evidence, as we talked about in a recent episode. I think factor tilting with a market cap weights as a starting point is also a perfectly fine strategy that also aligns with theory and evidence, as we're going to talk about in a future episode. And I did a YouTube video on DFA versus Vanguard that kind of covers that off. But as just an example, because this question's asking kind of for our opinions on this. I would be perfectly comfortable with my parents, who are clients of PWL currently, but I'd be perfectly comfortable with them being invested in market cap weighted index funds or a factor tilted portfolio. If I did not have access to the DFA global portfolios or to PWL to manage the portfolio for me, because that keeps my life really simple. If I had to DIY this, I would probably be using a single ticket market cap weighted ETF. That's if I had access to the DFA global portfolios like I do now, I would use them. But in a world where I don't have access to PWL and I've got to manage my own portfolio, I would not be doing something like the Rational Minder model portfolio because it's just, I don't want to spend time managing it and thinking about it. I've said this before in the Rational Minder community, and a lot of people were a little bit shocked. So hopefully people listening don't find that too shocking. But I would favor simplicity over factor tilts, given that choice. Now, we believe, and I believe that it makes sense. We, not including Dan, as Dan will talk about in a second, that it makes sense to have some factor tilts because it adds sources of expected return that pay off at different times from the equity risk premium. Recent history, like the last 15 years roughly, have been just dominated by the equity risk premium in the US in particular. As I talked about in my Dimensional versus Vanguard video, outside the US, factor tilts have actually been pretty good in recent history. But the US is such a big part of the market, and US large cap growth has been so dominant that factor tilting doesn't look great in recent history. But we've been in this type of situation before, leading up to the year 2000 and other times throughout history. And while the equity market dominated for a while and it didn't feel very smart to be tilted toward anything else, eventually that reversed. And when it did, being tilted toward small cap and value looked pretty smart. Now it does suck right now when factors are underperforming. It hurts. It also sucks when the market is flat, which has happened in the US many times. I think global diversification can do a lot of work there too. Like I mentioned that earlier, when we're talking about market cap weighting, ideally you're globally diversified. And that definitely helps with avoiding things like lost decades. But I think tilting toward other sources of expected return just gives you another thing that will pay off at different times. And I think that's pretty attractive. I think they're a little bit different psychologically from market cap weighting. Cliff Asness, when he was on Rational Minder, talked to us about how it's a lot easier to stick with a market cap weighted portfolio that's underperforming than it is to stick with anything active, which I would include factor tilts in. It's a lot easier to think that you know, yeah, we're going through a bad period for stocks, but stocks aren't broken. I think it takes a lot for people to believe that stocks are broken. But factor tilts or any other active strategy, I think it's a lot easier to believe, hey, this isn't working. Maybe it's broken. And so it's just harder to stick with. That's also part of our job as advisors to help people through periods like that. And then one other interesting point that I would make on this is that because we talk about this stuff on this podcast and on my YouTube channel, the people that come to us, like if someone contacts me and says, "Hey Ben, I'm interested in being a PWL client," they're expecting us to use a factor tilted portfolio. They know why we do that, and it's what they want. So, I mean, for that clientele, if we were to flip it around and say, "Hey, actually, no, we're going to do market cap weights," they'd be like, "Oh, well, that's not what I want." And actually, we less so in recent history, but I don't know, probably 7 or 8 years ago, we would get people contacting us who had found your blog, Dan, and read about indexing, and they'd come talk to me and Cameron, and we'd be like, "Yeah, we do this dimensional thing," and they'd be like, "Oh, I wanted index funds," and so just because that expectation was different, it didn't work as well. But for the type of people that come to us now, it's what they expect, what they want, and I think it works. It works really well. So that's my those are my comments. But Dan, I think your comments are going to be more exciting, Dan.
Well, I mean, mine are, it's interesting, right? Because I think so much of the debate around factor investing versus market cap is about research and about the theory. And the experience I'm going to share with you is just exactly that, is the experience of, a dozen years working directly with investors. And I can explain how I kind of came around to this. So, I mean, I'll back up a little bit and I'll say, all of us, I think, at some point in our lives went through a period where we were just learning about indexing, passive investing as a theory, because it's not something that comes to us easily. And somebody else brought up in one of the questions that this is not something that, takes a couple of hours to get. You really have to delve into it. And so once I got through kind of the OGs of indexing, right? Bogle and Burton Malkiel and all of these ones, books from the 70s and 80s and 90s, I started to encounter a lot of other authors who were advocates of passive investing, and I felt we were all kind of aligned. Larry Swedroe, Rick Ferri, even Scott Burns, who interestingly was the guy who created the term couch potato portfolio. These guys were writing about their own firms that they worked for, and they almost all of them use dimensional and use factor tilts. And so it seemed to me like just kind of the next level of indexing. And so I was very much influenced by that early on. And if you go in the Wayback Machine and find some of the blogs that I wrote 10, 12 years ago, I was quite enthusiastic about it. So that's the approach that I came into it. When I joined PWL, which was 2013, our team in Toronto was using a mix. We typically had portfolios that were roughly half dimensional and half market cap weighting. It was kind of a way of getting a bit of a tilt, but also keeping fees a little bit lower. And that's the way we build portfolios. But I remember very early on, my colleague and my mentor in this business, Justin Bender, was already starting to be a little bit uneasy about it. And we had a lot of conversations about it. And I remember him telling me that, clients are very sensitive to tracking error, especially if you use a passive approach. And he would say that, during these periods of underperformance, which you're going to always get with a factor tilt portfolio, he was having a lot of meetings with clients who were quite frustrated and said, "Listen, I thought you guys tracked the market. Why did I just underperform, 5 percentage points last year?" And this gets back to, I think, the comment that Cliff Asness shared with you, which I think is very wise, which is, active investors expect that there will be some periods of underperformance. I mean, unless they're completely delusional. But if you're going to call yourself an indexing advocate and say that your goal is to track the market, if you don't track the market very closely, clients tend to get frustrated. And again, a lot of this is self-selection, right? Because we did not have droves of people coming to us saying, "I know you guys use factor tilts, that's what we want." We got droves of people coming to us knowing that we had written and talked about market cap weighting investing for years, right? So their expectations, I think, were different. Um, and I have to say that in terms of consistency of approach, I was really particularly sensitive to this because I had spent years building a reputation telling investors give up on the idea of trying to beat the market. It's extremely hard to do over the long term. No one really needs market beating returns in order to have a successful plan. And so I found it personally very difficult to sit with someone and try to make the argument that one of the ways we added value is to build portfolios with expected returns that were higher than broad indexes. It just was inconsistent. And I wasn't comfortable with it. I'm still not. And, as I said, that's not your experience, I think, was very different from mine. In fact, in many ways, it was the opposite of mine because the types of prospective clients you attracted were looking for something different. Right. So, very early on, very shortly after I joined PWO, we just made the decision, at least on our team here, to just go with straight up plain vanilla market cap weighted ETFs. We still do it. I like the clarity of purpose. I like the consistent message. And I always joke that my performance reviews I do with clients now, like the portfolio review is the most boring part of the meeting because there is no surprises. There's no excuses. There's like, you knew what this was going to be. Here are the specific numbers. And I think that there's a lot to say about that I think that it really improves the relationship that a client has with an advisor if they're not talking about performance too frequently and not expressing whether it's frustration with out or underperformance, or even trying to explain outperformance, right? Obviously, people are happy to get outperformance if it's there. But I just prefer to talk about investment returns as little as possible during the meetings because that's the one part of the plan that we have no control over. Right. So, and then I think just to finish up, the last thing I would say is, and I really have to give a nod to Justin here because he was really the person who showed this, is that I think there are ways to improve returns in a market cap weighted portfolio at the margins. And when I say improve them, I don't mean beating the market, but I mean keeping fees and taxes to a minimum, because those are the things that are under our control. We can do some things on the margins to scrape a few basis points here and there. We use GICs as well as bonds for fixed income in our clients' portfolios. There's no MER, there's less volatility. These are things that can, slightly improve the situation. We use tax efficient discount bond ETFs and taxable accounts. We use some asset location strategies and things like this. And again, it's about reducing friction. It's not about market beating. But I would rather try to eke out a few basis points that way rather than striving for market beating returns that frankly might not materialize. Like reducing fees and taxes is something that always works. Whereas tilting the portfolio sometimes works and sometimes works against you. So, I think we all agree, right? I don't have any objection at all to using factor tilts over market cap as long as everything else is equal, right? You've got to get everything else right with your personal finances in your plan. And that's as simple as paying down debt, saving regularly, building a portfolio that's diversified, low cost, stick to it with discipline over the long term. And if you're doing all of those things, the impact of the factor tilt versus market cap weighting is likely to be so small, it's really not even worth worrying about.
Yep. So I think all that makes sense. I think so much of it is about the client's expectations. Like if they come in expecting one thing and they get something else, it's really hard in either direction. Like I think if we flip flopped and said we're switching to market cap weights, a lot of our clients would be pretty upset.
Sure. Yeah, because it's an inconsistent message.
But I think a lot of people come to us and don't know what to expect either, right? Like it's incredible for me to listen to the two of you have this conversation because many listeners will know my journey to where I am today was first stumbling upon Dan's blog about index funds and having like a full-blown epiphany moment. And then in 2017, when the Rational Reminder launched and listening to that, a second sort of epiphany with factor investing. So it's just really cool, as an aside, to hear you guys talk about it, because you were both so influential over my own thoughts about how to design portfolios, right? But Dan, I think you made an interesting point, is that like index funds, I think you can kind of grasp index funds in a couple of hours. Like it's relatively simple, and there's a couple of very compelling narratives that just make a lot of sense and resonate with people about why something like this might work, right? Like market efficiency, low fees, and the statistics back it up. I think it's a lot more difficult to understand factor investing to the point that you can actually tolerate the tracking error that you mentioned, right? It's one thing to kind of get it and to listen to the podcast, but to really, really understand factors and to have the tolerance to sit through that tracking error for a long time, to your point, is very, very difficult. And so I think, and Ben, you've said this before, this isn't like the hill that any of us would probably die on. There's so many more valuable things that you can do, not only as an advisor, but as a DIY investor or planner, to move the needle, that are more important. And I think this is like about optimizing the last mile kind of thing, right? Like if you're at the point where you're deciding between global market cap weights at a low cost or a simple, elegant factor tilted portfolio at a low cost, like you're probably 98% of the way there already, or hopefully you are.
Yep.
Yeah, and the fact that you can get access to the factor tilted portfolio now without a lot of complexity, right? Like, I mean, you made the argument, Ben, like if you had to get it by building a portfolio on your own with 7 ETFs, then there's a real argument for not doing it, right? Whereas if you can buy a dimensional balanced fund and not have the complexity, or if you're working with an advisor and you're not the one managing the complexity, obviously the argument is much stronger.
Yep. And that's gonna be different for everyone. Like I bet you, Dan, there's still people out there investing in the Uber Tuber successfully, or some modification,
or unsuccessfully. Yeah.
Yeah, maybe. Yeah. And then there are probably people, I know there are people using the Rational Reminder model portfolios successfully with a bunch of ETFs in there. And there are tools out there now that I could probably give more credence to or more weight to in my thinking about this, that make it easier to manage a portfolio of ETFs on your own. But even still, I mean, just tax reporting and stuff like that, I really like simplicity. So that wasn't really a very exciting debate as we kind of expected. But yeah, it's interesting when you look at, you can take any of this so much further than either of us do. Like what we do is so close to market cap weighted indexing. It's a bit of a tweak, and it'll have some tracking error, which does matter for sure. That's what even Gerard O'Reilly from Dimensional talks about that. Like the biggest risk in factor investing is probably tracking error and not being able to stick with it when it doesn't perform well. But there are people that take the concept of evidence-based investing and push it so much further than we do. You could be levered long short in a factor portfolio, and there are products that do that. There are products in Canada that do that. But yeah, I think what we do is relatively tame.
Yeah, the differences are smaller than I think people might think, right?
Totally.
Yeah.
Yeah. Yeah. I do like the fact that particularly right now with the US stock market, and I'm not advocating market timing or making a prediction, but being underweight those massive high price companies in the US market, and I'm totally biased right now because I'm working on notes for a future topic, I guess. I've got to send it out to a bunch of people whose research I've based it on to make sure that I'm representing it properly. But I've been writing about the potential effects of index funds on markets. There's a bunch of quite interesting papers on that. And after going through all that, I'm like, you know what? It feels kind of good to be a little bit underweight, just in case some of these effects that models suggest may be affecting prices are actually affecting prices. But global diversification also helps with that. So it's not the only way to, I don't know what the right phrase is. Cut the cake? Make the cake?
Skin the cat?
Better than skinning a cat.
Yeah.
Skin the cat, yeah.
Nice, guys. Well, 22 minutes in, and we got through one question. Congratulations.
But it was a big question.
It was a big answer. Okay,
Who
on to
wants
the
to
next
read
one. I'll read
Yep.
the next one. Previously, I made some stupid investments which caused permanent losses, mainly because I kept holding and wished they would come back to recover the loss. But in fact, they got worse and worse. Those equities clearly have no potential. The longer you wait, the harder it is to stop the losses. So how do we handle this situation and overcome it psychologically? I know it's optimal to take the loss ASAP and invest in better opportunities like index funds, but it would take a very long time to recover the loss and heal the pain. I guess this may be a common question for retail investors, so I hope we could discuss this topic and benefit everyone.
All right. I think it's a good question. I've got two tools for this. One of them I've used for years, and one of them, a client that I was working with actually came up with the idea. So one is to just ask yourself, if you had the equivalent amount in cash, would you buy the asset? So it's like you bought $100,000 worth of ARKK at the peak and took a 70% loss, as many investors actually did in real life. And so now you've got $30,000 in that position. Big loss. The question to ask yourself is, if you had $30,000 in cash, would you go and buy ARKK? And I think a lot of people reframe it that way and are like, yeah, no, there's no way I would buy it. Well, then, okay, you should sell it. Mm-hmm. That doesn't always work though. And then the other one that the client actually came up with is to dollar cost average out of the position. So if you go through the endowment effect one, where it's like, okay, if you had the cash, you wouldn't necessarily buy it, but you're still nervous about it, but you know you want to sell, you can put a system in place to sell out of it in the same kind of way that you would dollar cost average in to a position. So you just do whatever, 10 chunks over the course of 10 months or something like that, sell it off in pieces, and then that helps to minimize the regret of selling it all at once before it recovers. So those are the two ways that I would frame that decision. Do you guys have any thoughts?
Yeah, it's the same. The first one is the same one I use all the time, kind of just reframing it. And the interesting thing about that, I've never done this, but it just kind of came to me, is like, you can actually, thinking about that question like theoretically, I think it's hard. It's like picking, going through a risk tolerance questionnaire. It's like, pick the fund that you would have actually invested in, and they show you 4 funds, and one's more volatile with higher returns and one's a straight line. And most people just pick the one with the highest returns, because with hindsight bias, it's just so easy to say, I want the one with the highest returns. But if you had to actually live through that volatility, it would have been very, very difficult to do. And so this sort of theoretical question of, if you had the cash, would you buy it today? I think it's easy to kind of trick yourself into saying yes, but you could just sell it and buy it back tomorrow, right? Like, okay, go do it then. Like, literally, like, there's very little friction these days, especially if you've got an account to like one of the discount brokerages. There's very low commissions. Okay, so sell it and buy it back tomorrow. My guess is that if you did sell it, you probably wouldn't actually buy it back tomorrow. Like, once you've made it real and now you actually have the cash, I think you might often come to a different decision.
Yeah. I use the first one all the time as well, like you guys, and usually it works. I will say there was one time I remember having this discussion with a client who owned a stock that had lost a ton of money, and he was doing the sort of, I'm going to wait until it comes back before I sell it. And so I used this framing with him. You know, I said, look, if you think it's worth holding, then it's probably worth buying more, expecting that he would say, yeah, you're right, I'm going to sell it. So he bought more.
Oh, no.
So I said,
Did it go up?
I mean, I don't even remember, but I guess, like, I will give him credit. At least he had the conviction to follow
Yeah.
through on that framing. But yeah, that's the only time that's ever backfired. But
That's interesting. It's funny just reading through that question, how many biases are at play, right? Like, Ben, you mentioned the endowment effect. You've also got loss aversion. You've got anchoring bias. You've got mental accounting. Like, there's probably others that I'm just not identifying. But that's like one of the primary kind of cases for prospect theory, is this issue of like, I bought it, it went down. Now what? You have to overcome so many biases to make a smart decision, not necessarily an optimal one, but just a good decision. It's very difficult for people.
Yep. Want me to take the next one?
Sure.
Yep.
All right. The question is, what are your thoughts on the role of bonds and fixed income in a portfolio? Scott Cederberg's research really suggests that there is no reason to hold bonds except for behavioral concerns, but I just can't seem to make the leap to get into a 100% equity portfolio.
This is gonna be another Ben and Dan debate, isn't it?
Yeah. Not really a debate, I don't think. I don't know. I love Scott's research. I think he did a great job, and we actually have him. Mark and I recorded an episode with him, but that's coming up. I think the week after this one gets released, because he's got an updated version of his paper that we're going to talk through. But I think it's worth keeping a few things in mind. One is that stock markets are more integrated now than through some parts of Scott's sample period. And that could limit the effect of international diversification going forward relative to their sample. Because that's really their finding, is that international stocks are better diversifiers than bonds in a portfolio. They do look at this though. The figure C1 panel D of the new paper studies the strategy performance conditional on the realized correlation between domestic and international stocks, because they got this feedback as they were kind of going through the conference circuit. People were saying, well, this is probably all driven by historical correlations being low, but now that markets are more integrated, you shouldn't expect the same diversification benefit. So they find that the interesting thing is they find that the ruin probability of the optimal 100% equity strategy is stable across the correlation quintiles, but the other strategies actually have much more dependence on correlations. So the other strategies, like they do the 60-40 and the target date fund, those have higher probabilities when realized domestic international correlation is low, which is interesting. So they say in the paper, whatever the underlying causes may be, the results in panel D assuage concerns that, is that you say that word? Assuage? Concerns that, I don't know. I don't think I've ever spoken that. Assuage concerns that a high correlation between domestic and international stocks will invalidate the optimal all equity strategy. And then the other thing to think about is that stock valuations are high. Like I mentioned a minute ago in the US, they're quite high, although they've come down quite a bit recently. Markets have been a little rocky. But I think because investing's become easier and safer, and we talked about this in a previous AMA episode, it's possible that stock valuations are just higher. Like the normal, whatever that means, level of valuation is higher and expected returns are a bit lower than history. So if that is the case, that could be another argument against stocks research supporting 100% stocks. They do look at this though in the new paper. They condition the optimal strategy on the domestic stock price to dividend ratio. And they find in that specification that in the bottom 4 quintiles of the price dividend ratio, their hypothetical couple does maintain an all equity strategy, but in the highest price quintile for domestic equities, their household does allocate to bonds with a 9% weight. And that optimal portfolio in that scenario does give a bit of a utility gain. The way that they do the analysis in the paper is their base case, the couple saves 10% of their income, and then they kind of model that through the life cycle. And then to compare alternative strategies, they ask how much equivalently would the couple have had to save with this alternative strategy to match the optimal strategy. And conditioning on valuations, they would have had to save 9.7% of their income instead of 10. So it's a little bit nice. But then I think the other big thing to keep in mind is that we had this long discussion in episode 343 on how to choose an asset allocation, and behavior matters a lot. So being like, yeah, the data says I should be 100% in stocks, so I'm going to go 100% in stocks. That's probably not the right decision for most people. I think Scott's research is interesting because it shows things like, hey, international diversification is really important. Hey, bonds maybe are not super safe over very long horizons in real terms, but that neither of those things do anything to mitigate the behavioral effects of volatility on investor behavior. So that's, I would probably argue, more important than what is statistically optimal.
Yeah, I'm going to jump in, just say like it's interesting how often we hear questions with that premise. And it seems, and what I mean by that is it seems that, a fair number of people, I think, believe bonds are in a portfolio to somehow enhance returns. And it's just, that's not the case. Never has been. You had said, Ben, for example, like bonds, don't reduce, whether it's volatility or over the long term, but bonds are not in there for the long term. Bonds are in there to control short-term behavior. To say that my joke here was like, to say there's no reason to hold bonds except for behavioral concerns. It's like saying the only reason to add cold water to your bathtub is so you don't get scalded and jump out. Yes, that is correct, right? It's just, let's not just wave our hands and say, oh, it's only behavioral concerns, because behavioral concerns, it's the single biggest reason why people fail in investing is bad behavior. So if you can have an ingredient that improves your long-term behavior, then, what's that worth? It's worth a lot. And if you want to focus specifically on the short term, we're talking about here, or at least I'm talking about people who are in the drawdown stage. And if you're taking money actively out of your portfolio, yeah, I really think you should keep a few years worth of cash flow in, not necessarily short-term bonds. They have their own issue with volatility, but what cash GICs, and simply because, believe me, I've had these conversations with people many times when they're drawing down their portfolio as markets fall. It's extremely reassuring to be able to say to someone, you don't need to worry about equity volatility right now because we've got 2 or 3 years or more of cash flow in safe investments that are not going to be affected by that volatility. And that is enormously comforting to people. And, it's sort of, it's not a research question. It's a question that you get the answer to it after you work with enough people.
Yep, I agree with that. I think managing behavior is so important to total outcomes, right? Like it's easy to look at what's the optimal portfolio, like historically and mathematically and statistically, but actually tolerating that portfolio over a 60-year time horizon and not making mistakes with it is the tough part. So to the degree that bonds can help you prevent a mistake, you can end up with a better outcome by using them, right? I'm 100% equity. I expect to always be 100% equity because I'm a perfect investor. I'm robotic in my approach. My son is a different story, but I am absolutely infallible with my approach to my portfolio. But it's interesting because I absolutely respect that as I get older, I might completely change how I view that. So I expect to be 100% equity myself, but absolutely leave room for, I just might not need the stress of it when I get older and have to make those drawdown decisions too.
Or do you mind if I ask you, like, roughly what percentage of your clients are 100% equities?
Well, it's a good question. So I have a smaller number of clients than the typical PWL advisor because I wear a couple hats, but I don't push towards 100% equity. Like we've talked about kind of our risk profiling process before, I think, on the podcast, where we use a combination of like psychometric results from their own like experiences and perception about risk, and they answer a questionnaire, and then we combine that with a more quantitative kind of view of their capacity for risk. Very few people come out with an acceptable score that would allow us to put 100% equity in their portfolio. 20% maybe. And we also have to remember my clients typically err on the younger side, I would say, like in the 30 to 45 range. So there might be more kind of capacity and tolerance for risk there. But yeah, I don't know that I've met a lot of people over my lifetime that can sit through the kind of volatility we've experienced even in the past 10 years with things like 2018 and COVID and not make a mistake.
Yep. I'd agree with that. The number I have is extremely low.
Mm-hmm.
Yep.
Yeah, it doesn't surprise me.
I'd have to look at our data, but it's material, the number of
Yeah.
clients that have 100% equity portfolio. And there's definitely advisor fixed effects there. Like if and there's a paper on this, like advisors have big influence on their clients' portfolios based on what that advisor's, what their fixed effects are. Like what that advisor thinks basically has a big influence on what their clients' portfolios look like. That one paper I'm thinking about is it shows that there's much less variation based on client circumstances, but a lot of variation based on advisor fixed effects, advisor preferences, I guess, and perceptions.
Yeah, that's interesting because obviously all advisors have some biases, but it shouldn't be the biggest factor, right?
It
be
is,
a
yeah, it
factor, but
Right.
yeah, client circumstances should obviously be the biggest effect there.
Yeah. Yeah, that's why that paper was kind of a bombshell paper. It's in the Journal of Finance. It's pretty interesting.
Ben, that's a separate paper than the one that shows that advisors invest in the same products that they use for clients, even if those products are not great. Is that right? It's a totally different paper.
Same group of co-authors.
Okay.
But it is a different paper.
Yeah. But you can see the influence just from that paper alone on what ends up in client portfolios is largely based on a lot of it, that individual advisor bias, right?
Yeah, yeah, definitely. I just wrote a video and recorded on sequence of returns risk. And based on the conversation we just had, you guys are going to rip me apart for it.
What, it doesn't exist?
Well, it talks about like the Cedarburg paper, but there's also a couple of other papers that look at sort of optimal retirement portfolios. And they all find that being equity heavy is generally quite favorable. And there's one that looks specifically at the cash bucketing strategy. And the author of the paper kind of acknowledges like, yeah, this probably feels good for people, but shows that it's suboptimal relative to having a static asset allocation and drawing it down, not addressing the behavioral components. And then what was the other one there? Oh, in the most recent version of Scott Cedarburg's paper, they do one optimization where instead of finding the optimal fixed lifetime asset allocation, they find in each year of the simulation, they find the optimal asset allocation. And in that one, they end up with 100% equity up until retirement. And then they shift into 27% bills for I don't know, it's like for 7 or 8 years, and that slowly draws down and they end up back at 100% equity. But that was interesting because they had this big allocation of bills at retirement. Then the other interesting thing is that that was based on a 4% withdrawal rate, a 4% spending rule. But then they switched the spending rule to a proportional 4%. So you're spending 4% each year, which means your spending is changing in dollar terms.
Of the remaining balance?
Of the remaining balance.
Yeah.
So 4% rule, like the Bill Bengen 4% rule, is you spend 4% of the portfolio in the first year and then increase that by inflation each year thereafter. And the proportional 4% is you spend 4% of the remaining portfolio value every year. And so if your portfolio drops, your spending drops proportionally. And so when they switch to that proportional spending rule, the allocation to cash goes away completely. So my comment in the video is that sequence of returns risk is better described as sequence of withdrawals risk because you're not forced to take the same withdrawal every single year. Anyway, that's it.
But I mean, there's a couple things there, right? Like one, obviously, if you have a fixed remaining balance, a fixed percentage of a remaining balance, it can only ever approach zero and never
correct
run out theoretically. So it's not a surprise, but the variance in spending can be absolutely massive. Like your tolerance bands for going from spending 60 grand a year to 40 grand a year might be absolutely, intolerable for you. So I think it's kind of a combination, right? Like sequence of returns risk absolutely exists, and a variable withdrawal rule is a great solution to it, or a great part of a solution kit to it. But I think you've talked about this and modeled this, Ben, like having floors and ceilings and guardrails and that type of thing. Like there's a lot of ways to kind of tackle that problem. But sequence of withdrawals risk, I think, is a good way to frame it to the degree that you can actually tolerate massively changing withdrawals.
Yeah, I did model that actually. I had using the Dimson Marsh Staunton data, I did a safe withdrawal rate using 100% stocks, and it was 3.2%, so 32,000 a year on a million. And then I did an amortization based withdrawal rate, which Ben Matthew talked about when he was on, and it was able to sustain, I think it was a 3.65% average withdrawal, but the lowest year was like $17,000 in spending. So you're taking almost a 50% haircut to your spending relative to the 32,000. But yeah, I think it's one tool, like you said, Mark, and there are definitely kind of guardrails. There's one that's actually called guardrails, but there are different systems that you can put in place so that your spending is not actually that volatile. But I do think it's interesting that there are two ways to solve the sequence of returns problem. One is by trying to do stuff in the portfolio. One is adjusting your spending. The optimal answer is probably somewhere in the middle for any individual. But I did think that the fact that the Cedarburg paper with a fixed withdrawal found that optimal cash allocation was pretty interesting. And the other thing about that is that it was optimal by 10 basis points of savings. So remember that you have to save 10% of your income. The base case saves 10% of their income. In that optimal cash allocation case, their required savings drops to 9.9%. So it's kind of like, doesn't make that big of a difference either way. So I say in the video that if holding cash makes you feel better, it's probably not that big of a deal.
Yeah, I think in retirement too, this is another place I think where the theory and practice can differ a little bit. And that is, like in my experience working with clients who are retired and drawing down, their portfolio according to the plan that we've come up with for them. They don't want to be in a position where they are checking their portfolio value relatively frequently and then adjusting their lifestyle based on market returns. And in fact, I have often, as a planner, tried to insulate them from that, like by saying things, again, going back to that kind of cash wedge that you put in a portfolio to provide a few years worth of cash flow, but also to say, when because sometimes clients will bring it up. I think it's a natural tendency. They read the news, they know their portfolio's down. They say, maybe I shouldn't go on vacation this year. And I say, well, listen, remember, when we did that plan for you, we did not assume that returns were going to be the same every year. That's why we did the Monte Carlo. And so, no, you don't have to adjust your spending this year because the markets were down based on our average expectation. And I think that offers a lot of comfort to people in their retirement. It improves their mental health and their lifestyle as well. So you still have to revisit it. You still have to go back and redo those Monte Carlos once a year and do little course corrections. But you want to keep those course corrections, I think, as infrequent as possible. Because if a client's sort of thinking, well, market's up this year, I can spend a lot of money, market's down this year, I better stay home. That's not a recipe for happiness in retirement. It's really not. So I think we have to be careful with that. I don't think a lot of people will find that palatable.
Yeah, no, they don't. We've explained this to people too, and there's not a lot of interest in big variable spending plans. Even if it's like, hey, you can spend more throughout your lifetime, it's not very palatable.